Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today we have a guest on, Eddy Soffer. How you doing today, Eddy?
I'm doing great. Thank you for having me here.
Good. Well, we brought Eddy on because in the news we've seen a lot of back and forth on ESG. Certainly in the last few years has become a hot trend, and really just wanted to kind of dive right in. So we want to bring an expert on. So Eddy, maybe you could tell us a bit about your background.
Certainly. So I've been in financial services for my entire career, and originally from Latin America via the Middle East, so very international background. Speak a number of languages, and I'm very passionate about sustainability, starting from my background itself, but also from all the things that I've seen happen over the years. I helped develop the sustainability practice at my prior employer at Brown Brothers Harriman, and I'm ESG manager here at Interactive Brokers. And along with our director and the rest of our team, we lead the sustainability initiatives for the firm. So great to be here.
So when we talk about sustainability, what does that mean to you? Because I think for a lot of people, that's kind of maybe a squishy word, but what does that mean from your perspective?
Certainly, I'm glad you're asking that, Kirk, because sustainability or ESG means different things to different people. And I think that's still being hashed out and defined in the marketplace, and that goes from myself to regulators and others. So for me, sustainability is a way to either personally or companies themselves assist in not just thinking about, obviously bottom line is important, but also about how to help through your work or practices to help society and the planet or the earth. So that's, to me, at a high level, what sustainability means. And there's a lot of components within it, but that is in general terms.
Okay. So how would you said you compared that to ESG. So how would you define ESG compared to that?
Sure thing. So ESG stands for, for some of your listeners, environmental, social, and governance. So that encompasses three pillars and behaviors or practices that companies adopt that help for the environment, for the social part, which can be sort of the employees, workforce, of the supply chain and others, and then governance, which deals with management, which deals with shareholders, and board of directors and other things at a very high level. So those are the three pillars. And so all that encompassing sustainability, sustainable ways of helping, the planet and society. So that's what ESG is.
So how do you take ESG and sustainability and overlay that into investing?
Sure. So that is still continues to be defined. The way that we've done it here at our firm and the brokerage is by developing sustainable trading applications, right? And to do that, you need to first define what is sustainable investing, and what kind of vendors are you going to be using for your products to get there, right? And you'll see that quite a number of companies, from brokerage to asset managers to banks, all have their way of defining sustainable investing. And for us, we came up with a tool that allows users, and this ties into the initial point that we were making, to choose what sustainability means to them, right? And so they get to select what they care about most, which are their values or personal values. And with that, in the application that we developed, you have what we call an impact lens. So they're able to see their holdings, their existing instruments, through that particular lens, and they'll be able to see how closely aligned they are to their values through letter grades. To do this, we used underlying vendors, ESG rating agencies that are out there, to feed that information to us, which is the ratings on the companies themselves. And then we overlay it with our old algorithm that personalizes that journey. And then you'll be able to see things from your perspective. So it's kind of like having a fingerprint, right? It's your own personal way of looking at your investments. So that's how we do it through our impact tool.
So you mentioned a few times that a lot of this is still to be figured out. to me, it seems like what are the parts that still need to be figured out? Because it seems like the industry is very clearly defined. What is ESG with the ratings, and it sounds like they've made a lot of progress in that area. So what still needs to be worked out?
What I would say, Kirk, is that yes, you're seeing a lot of progress, but I don't think it's been worked out. There's still confusion in the investor world. Rating agencies provide their own input and ratings very differently, right? So one define it this way, one uses third-party sources, one doesn't. One has 5 stars, one rates it out of 100. So there's still a lot of confusion, and there's not much uniformity taking place. And I think that's where the regulatory environment is stepping in to try to put some order into a lot of different things that are happening out there, right? So that's my opinion, and you're seeing it. You're seeing even like the SEC stepping in, and we're seeing it also globally. Europe is far more ahead than the United States, and the regulatory environment has already stepped in to provide more order and to provide more uniformity.
But doesn't that in itself create more problems? I mean, Jim Grant was famous for quoting, I think it was 2012. He said, "There's nothing more unstable than a stable price level," right? Like when you uniformly create a certain standard, let's look at like 2008, for example, right?
Mhm.
Like the rating agencies obviously did a poor job by rating, piles of garbage, paper as AAA, right? I mean, there's a whole movie around this, and and they did that, and they did it because if they didn't rate it AAA, they'd go across the street and go somewhere else. So I'm not saying this is a problem for this issue, but I'm saying that if you don't have a market dictating the right approach, like a free market, then aren't you potentially creating other problems by somebody decides, well, this company is good and this company isn't? Doesn't that become a problem with this?
So what I would say to that, Kirk, is that the regulatory environment, even the regulators, are doing very close consultation with a lot of companies. A lot of the market participants that you are mentioning are being taken into account because this is new to even the regulators themselves, right? So there's consultations, there's comment periods that come into place, there is pushback that you're seeing. So I don't think it's being done unilaterally. It's being done in consultation and in a group forum, so they can come with the right approaches, and the market would agree with it because they gave input into it.
But I guess the question that comes up is, why are the regulators even involved? I mean, this is a market, a product that is put together by people who have certain beliefs and they have certain interest in certain types of investments. Like, why are the regulators even involved in dictating who's good and who isn't for ESG?
I don't know if the regulators are dictating who's good and who's not good. I think they want to put order and structure,
Okay.
right? So what's happening is that the investors are going in and looking at ESG data, as I was mentioning, it's different in different places. So there's confusion, right? It's like, okay, so this rating agency has this rating for this company, but it's totally different here. Why is that? And how do I move forward? So it's providing more clarity, providing more transparency that is needed. It's not so much telling you what's wrong and what's good.
Okay. No, that makes sense. Because I know, I think it was a year, maybe it was 2 years ago, I was looking at some of the ESG ratings, and there were companies like ExxonMobil
Yeah,
and
yeah.
I think Philip Morris or Altria, one of the two, I forget which, was, rated top in ESG ratings. Now, obviously, I think a lot of people would disagree with that for a few reasons, but
Sure.
I think the question comes, I have two questions. First is, how do you determine of the different criteria, the environmental, the social, and the governance,
Hmm.
how do you pick who's good in that in maybe some industries that are not aligned with that necessarily, like an environmental, like any sort of oil,
Hmm.
natural gas, would probably not be aligned with that, yet it's also a part of a diversified portfolio to have those in there. So how would you kind of square that circle?
Sure. And once again, everybody's got a different approach. What I would say is that it's important to see what industry the company operates, right? And how material. There's one thing called in like in ESG world, materiality factors, right? Like how much weight do you assign to the environment versus the social and governance. So if you take an oil industry, obviously the environmental factor is one that should be weighted more than the others, because at the end of the day, that's the industry they're in. But at the same time, you also need to take a look at how are they looking to put laws around things, or structure, or for example, how they're treating their employees. Do they have safety, when they're out in the oil drills? Is it something that is being taken into account? So what I would say is, to square it away, companies need to take a look at not just the ESG ratings themselves, but they need to also do their own due diligence, put in their own company hat, right? How are things done here internally? And me personally, I think you also need to talk to management, or look at sort of the ways in that they're being engaged, right? So they're in the oil industry. You can't completely pull them out, and this is my personal opinion, out of an index or anything like that, because they are probably providing good value over the shorter term. So you need to take a look at the longer term impact. What are they doing to transition themselves into renewable energy? Are they moving into that direction? How are their employees being informed about this transition? So there's a lot of factors to take into play, but I would say you need to take the ratings, but also apply your own personal knowledge and your own personal way of looking at it according to your company's analysis.
Yeah, because I think if you look at, I'm just pulling these up now, but if you look at the energy industry, ExxonMobil
Mm-hmm.
is the largest, Chevron is next, and they're larger than a lot of not tech companies, but they're larger than a lot of companies. You
Yeah.
can't really discount them. Now, if they have, and I'm not making any characterization about those companies, but if
Mm-hmm.
hypothetically they had bad corporate governance and bad social, standing, then okay, obviously that's something. But just I think one of the challenges, and I bring this up because in times where the markets are good, where there's abundance, where everyone's making money, and there's just money to go around, like we've had up until this year, like we've had 2008 till that year, that's what, 13 14 years. That's a long bull market, and most people made a lot of money. And so it was easier to look for the brighter side and say, oh well, I've got extra money, let's try to make the world better. But in bad times and recessions, things that tend to do well tend to be dirty energy, right? Or alcohol or tobacco or things like that.
Mm-hmm.
Historically, I bring this up because in the late 90s, there was something called social responsible, right? Which is, I think, an offshoot of ESG, correct?
Mm-hmm.
At the time, it was mostly tech companies, which pretty much every mutual fund had. So I can't fault them, because every mutual fund out there had tech companies only, because it was going up a lot. But as the ESG, I guess, movement has changed, how do they account for recessions? Because recessions, the dynamics change and people's interests change, and they're more focused on preservation. So how does ESG and sustainability affect that economic cycle?
Sure. And I would say that the way I view ESG is a longer term play. It's not necessarily through the short term. You need to take a look at it, in my opinion, also as a risk management tool, right? So you have to take into account that things take time to implement and to develop. So we were just talking about sort of the oil industry and other companies, that the transition period is one that's going to take some time. I think what's most important is to take a look at management and see their commitment in moving towards a more sustainable way of doing business, right? And I think that is the most important thing to look at. It's over the longer term. It's not a short term. So yes, we do have, from what we're hearing out there, perhaps already in one, a recession, right? And so it doesn't mean you need to like pull out of all ESG stocks or do all that. You need to take a look at it over the longer term. And I think that's the best approach to do, as opposed to just looking at results right away, because ESG takes a while to develop too.
Okay. So one question I have, because this comes up a lot, I get this question a ton from listeners, is,
Mm-hmm.
the ESG is in many ways about finding companies that you align with their values. First of all, is that a good idea long term? Right? Is trying to align your values with money, which isn't necessarily the same thing, right? It's doing good for the environment doesn't necessarily mean you're going to make money, right? They're independent.
Mhm.
So I guess the first half of the question is does that make sense for people? Like what are kind of your thoughts on that?
I think, Kirk, it depends on how important it is for a specific investor. So, is it more important for them to make a return, or is it more important to them to align with the values? Right. So, I think that's a personal decision, to be honest, that every investor has to make. Now, it doesn't mean that you can't look at it from two different lenses. I think in our tool we do give the opportunity for investors not just to look at their holdings through impact lens, which is aligning with their values, but also the financial lens, right? So then they're able to determine, do I have the stomach to sit on this if they're not aligned, or do I wait a little bit longer? So that is it's kind of like defining sustainability. Everybody has a different way of looking at it. So I would say that it depends on the investor itself. Some may have the appetite, some may have the resources to stick it out a little bit longer and say, you know what, my values mean a lot to me. I know I'm going to be hurting a little bit, but over the longer term, this is what I care about most.
Okay, well, that's fair. What and the other part of it is if you look at ESG and sustainability, there's this question of what good are you actually doing, right? Because once a company goes public, people are buying and selling it. You're not affecting management, you're not affecting revenues. So when you look at ESG, what good does that do by investing in these companies versus any other company?
Sure. I would say that this point is a very good one. I think it's changed over the years. Where I do agree, when companies go public, it tends to get a little bit trickier, right, in terms of the impact that you have. But today we're seeing a lot more interaction between very large asset management houses and management, right? So it's what they call stewardship or shareholder activism, and you're seeing that quite a bit, where people that hold large amounts of stock are able to opine on certain things, and they have the opportunity, and management is open to discussing that now with shareholders more than before. And I think what's also important, Kirk, is to keep in mind that the consumer has changed over the years, and now we have sort of like the millennial and the Gen Z that care deeply about this, right? And companies need to adjust their way of communicating and their way of being more transparent based on this new generation of investors and stakeholders and employees. I mean, they're the next generation that does care about these issues. So there is a way to engage with management now more than it was before.
Yeah, I would agree with that. I think management's more open to listening, although I think it's still the same, right? If you're a large shareholder, they'll talk to you, right? But if I'm Susie Lunchbox and I have 100 shares of a stock, they're probably not going to listen to me, right? I mean,
I would say, yeah, that's the case. But again, you have to take a look at your consumers. Who are your ultimate consumers at the end, right? And what are they buying or not buying anymore? You have to take a look at social media, right? I think the brand loyalty is becoming so huge right now that even some consumers may boycott if they don't feel comfortable. And that can spread quickly, especially today, more than ever before.
well, I think that's the ultimate point, right? Is that I guess the point I'm making is buying and selling stocks is maybe not necessarily the best definition of you expressing yourself, but boycotting the goods in the store, going on social media, I agree. I guess that's the line I'm trying to get somebody to explain to me is all of those things aside, which totally agree. People should do that. I think in a capitalistic society, we have a free market. People can buy or sell whatever they want as long as they don't hinder other people's ability to buy and sell what they want. I think that's totally fair. But when it comes to investing, sometimes I just find it challenging to say what good is this actually doing for people who believe in ESG and impact investing and sustainability. I'm just wondering. I'm just trying to find a good reason that this is like a great idea. That's why I ask.
Yeah, and I think from where I stand, I think impact investing does make sense. I was saying like over the longer term, I think it's gonna it's going to become just part of the normal investing process, to be honest with you. I think it's going to sort of morph. There won't be any more ESG. And in terms of the impact of an investor, I think that is something that we're seeing that it continues to develop. I do feel companies are now listening more than before. You may think you're one person, but I think there's going to be, as I was mentioning, a new generation of investors, not just consumers, that care about this deeply. And in the aggregate, they can make a difference, right? And I believe that's going to be the future.
Okay. So you mentioned impact investing, which is it's a related but different topic. Can you explain impact investing for the listeners who are not aware of it?
Sure, certainly. So that is a way of allocating financial resources into companies that are trying to, or not trying to, but are looking to do projects again that are good for the planet and society with an impact in mind, right? So, okay, this is the ultimate goal of this particular project, or this is the ultimate, outcome that we want as a result of the investing. So that's kind of like the word itself, impact plus investing gets you there.
When you talk about like trading and offering people different structures that they can trade through, what do you see as the future for ESG, sustainable investing, impact investing? Like, what does the future look like from here? Does everybody have to go through a screen? Is like where does this eventually go if this kind of keeps moving forward?
So I would say that eventually, the way, this is again my personal opinion, is that ESG will become part of the investment process. Just like right now, before making an investment, you do have your checklist, sorry, of things that you need to look at from financial metrics, right? This is the ratio we're looking for. Or this is the number of assets that we're looking for, the liquidity and all those things. I think that ESG is going to become a part of it because I firmly believe it's a risk management tool, right? So it's going to be one of the other things that will need to become part of the investment process because over the longer run, it will make a difference. So that's where I see the future of ESG investing.
So when you say risk management, what do you mean? Could you define that a little bit better? Because there's lots of risks out there. So which ones
Sure.
is this
So
defending against?
absolutely. So the factor of ESG in itself, right, is environmental, social, and governance. So again, it's like, okay, for the environment, for example, what is a company doing to make sure that there's no oil spills, for example? What things are they doing to make sure that they're transitioning towards clean energy? On the governance side, how they're treating their employees, how are they responding to consumers' concerns? All the things that I mentioned, Kirk, are things that companies need to address, right? They happen to be bucketed into ESG, but those factors do help companies over the longer run. Because if you don't address those issues, you can have lawsuits, you can have oil spillages, there'll be legal repercussions. So there's quite a number of consequences that happen if companies do not address those three pillars. So that's what I mean by risk management.
Okay, no, that makes sense. And I would think there are companies that are going to have high exposure to environmental, and then you have other companies that have very low exposure to it, right? I think we can all agree that corporate governance is an important part of it. Although I think that if you look at it, it's also kind of a fluffy one unless you put some teeth to it. So I'll give you an
Mm-hmm.
example. So Warren Buffett, I'm not going to name the company, but Warren Buffett has invested in a number of companies for decades. One of those companies in the last few years, let's just say their corporate governance had a lot to be desired. And only based on what Warren has said, I'm not making judgments on the company itself. I'm just saying, based on what Warren has said in the past, that his criteria, this company no longer met his criteria, but he kept investing anyway. So, I kind of, without naming the company, because I don't really want to go down that rabbit hole, but my point is there comes a time where you have to make a choice, right? And for him, he's had a company for decades. He doesn't want to sell it. He's got to pay a lot of taxes on that. So, when it comes to governance, at what point is there like a hard line, or how are they going to characterize governance in a way that is easy for people to actually comprehend it? Because that there's so many areas of corporate governance that could go.
Yeah. And once again, I'll state my personal opinion on this, but I believe overall governance is a way to look at the stakeholders, not just shareholders, but stakeholders. I mean, also your consumers, your employers, your employees, and everyone. Make sure that those areas are being addressed and make sure that those areas are being covered. Because I believe that that is the way that a company can continue to operate in a successful fashion. Of course, the shareholders are important. That's important. And obviously, the investors are very important. But for all of them to profit together, there are other pieces of the puzzle that also need to be taken a look at, right? And so that will be, as I mentioned, consumers and others, and making sure that they're listened to. And obviously, there's certain things that will not be able to be adopted, but they should have a voice that they can express. And that's where governance comes into play. So having procedures and policies in place that allows all people to comment on where the company's going.
So, you know, obviously things are not 100% sorted out with any of the categories that's still being worked through, but what, based on what you've seen and the trends that it's taken the last few years and the trends that are happening now, how long do you think it would be before you think the ESG ratings are more or less aligned with, I guess, industry reasonableness? So there's uniformity, more or less uniformity amongst the industry of what's reasonable and the way things should be. Like, how long do you think that's going to be before that really happens?
It's very difficult, Kirk, to give you an exact number, because I
Ballpark.
think that, yeah, I would honestly say over the medium term. I do think that it's not in the longer term, because rating agencies are being used by a lot of different companies, asset managers, investors. So I think that issue is something that is pressing. I do believe that the regulators I've been hearing are going to start looking to rating agencies themselves, right? And I think that probably informally that's already happened. So I do believe over the medium term that is going to take place.
Okay, that makes sense. All right, so as we're running up against time here, any final thoughts from you or areas you want to talk about we haven't really touched on?
Sure, I would say just you know, that ESG continues to develop. I know that, you know, and for your listeners out there, I'm sure that they're aware there's some good sort of press on ESG and some negative press on ESG. In my opinion, it's something that is good. I was talking to you prior that ESG probably 5 or 6 years ago was not even mentioned. People didn't even know what it was. So it's good to have it out there. It's good for people to start focusing on it, because it's going to be, in my opinion, adopted in a way that's going to assist companies over the longer run. And it's going to address sort of all the concerns and needs of the new generation of investors. Yeah, so that's what I would leave your audience with.
Okay, and where can people find more about you?
Sure. I could be found on LinkedIn under Edward Soffer, and also check out our website, impact.interactivebrokers.com. This is the tool that I was mentioning before, and the app itself, Impact by Interactive Brokers, can be found in the Apple Store and the Google Play Store. And this has been great. Thank you for having me, Kirk.
Great. Well, thanks for coming on, Eddie, and sharing your wisdom with us.
Thank you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Eddy Soffer. Glad he came on the show to give us his perspective on ESG, sustainability, impact. I know I'm looking to get some people on the show that are on the other side of that issue because I think it's a very interesting issue that's getting a lot of debate. But we're going to debate this on the show right now. So we got this week we have our very own Doug Heagren. Hey, Doug.
Hey, Kirk. How you doing today?
Good, good. Well, our favorite two, well, some of our favorite two ladies. We also have other favorite ladies, but some of our favorite ladies are not with us this week, so it's just gonna be Doug and I, and we're gonna talk about this issue. So, Doug, what are some of your thoughts about ESG? Just to kind of start it off.
Well, I guess my first thing is, what is it, Kirk? I still haven't figured that out. I mean, ESG in itself, in essence, is, I think, has a lot of confusion about it, right? You know, is it sustainable? Is it ESG? You know, back in the day, we had things like that, you know, the social responsible investing, otherwise known as kind of impact investing. And, you know, I mean, there was a number of different ways people have kind of labeled this, you know, package over the years, green, ethical investing, things like that. And I think that as long as they keep trying to repackage things and redefine it, you're going to continue to have an endless amount of confusion into what this actually is. And I think that's the big takeaway is, well, you know, how do you know? I mean, this is something that is probably more than anything a philosophical type of investment strategy, not necessarily a, you know, not necessarily a financial or a money making type of strategy. I'm not saying you can't make money in ESG. I mean, again, there's a lot of money being thrown at ESG through, you know, various venture capital, lots of people that want to push us into this world of basically having some sort of, you know, again, arguable ethics or philosophy around environment, social governance, because that's what it, you know, ESG stands for, or sustainability. But again, you know, whether or not that's going to make money is, you know, neither here nor there. I mean, again, like anything, are you going to invest in a good company that becomes the next big thing, or one that it just sounds good but can't, you know, but is hemorrhaging money into oblivion until it's no longer a fad anymore. But I think but the reason that people get into this, generally speaking, is going to be more of a philosophical reason of feeling good about what they're investing in, more than necessarily looking at it as something where I'm making a best choice for my investment portfolio to make money. Because there are lots of great sin things to make money in, right? Guns, you can make money in tobacco, you can make money in I guess guns fall into war profiteering. You can get money, you know, make money into commodities and things that some people think are destroying our world with pollution. You don't get into ESG, you get into ESG generally because there's maybe a philosophy of trying to avoid that. I mean, because it may not necessarily make you as much money to go about that route. But then, and I've had these conversations with clients, well, I want to invest in those type of things. How do I do it? And I think that can, that's a great question, right? How do you do it? Because I think what a lot of people are packaging and labeling as these ESG things, again, like anything, you better look under the hood.
Yeah, I think that's a good perspective. And I want to follow up from the interview with Eddy and make a few points, because I think, Eddy did a good job of kind of describing ESG and impact, socially responsible and sustainable investing. But I do want to make some points here. I think there's nothing wrong with investing for the purpose of wanting to make the world a better place, if that's your intention. So I think for perspective, there are a lot of family offices. And those of you who are not familiar with what a family office is, a family office is basically, let's say I sell my company for like $1 billion and I decide now I've got this $1 billion. What am I going to do with it? What a lot of people will do is they'll create a family office, which is basically a bunch of people that are helping manage that $1 billion and your life. So it might be, getting you plane tickets to travel to the place you want to go. It might be, what projects do you want to invest in? And what I've found over the last number of years is the impact investing has been a big issue, say for the last 10 years with family offices. And the point is they want to invest and make money, but they also want to make the world a better place. So I think what you'll find is if you're looking at people who are like ultra high net worth people, once you get to a point of having enough money, you also want to do good in the world, or you want to shape the world in your vision of what you think it should be. And that might be the right or wrong thing. We're not making judgments, but the point is people don't want to just invest. They also want to make a difference in an area that is meaningful to them. So that's a big part of what impact investing is. I think one of the challenges that we run up against is, as Doug said, there's been a history of Wall Street packaging up products for this, what is now ESG. It used to be called socially responsible in the late 90s. There were a bunch of funds that were called socially responsible funds. Some were pretty good, although they were primarily invested in tech, which in the late 90s, as you know, did very well. So these funds looked like they were doing well. But as soon as the 2000 and the subsequent years hit and tech didn't do well, these funds didn't do well. Now, it's really easy to make tech fit the socially responsible because it has a lot less impact than an oil company or tobacco or firearms or alcohol. All these sin stocks that they tend to do well in bad times, because in bad times people are still drinking, they're still smoking, and they're still eating bad food or whatever, and they still have to put gas in their car. Like, all these things happen in bad times and good times. The problem is in good times, other things just do better. So what I think people need to recognize is there is a difference. If you want to make money, then you pick the best investments that are going to make money. If you want to do good in the world, then you should find ways to do good in the world. If you try to combine them, it becomes more problematic. Now, what I would suggest is, if you want to do good in the world with your money, invest in the best things and then take the profits and invest it and put it into things that you can do good in the world. But if you try to do both, sometimes you can succeed and sometimes you can't. But Wall Street knows this. They know that you want this, and they're going to package up products that are going to come right up your alley and going to look very appealing to you. And this is not a characterization of the quality of the products, but this is Wall Street's job. If there's a trend, they're going to find a product to fill the trend. If you look at any trend, whether it's coal, whether it's energy companies right now, whether it's nuclear, whatever it is, they're going to come up with a product to fill the need for what people want to invest in. So just understand that, and just know what you're getting yourself into, and understand, is this something that you want to do? Now, I want to talk a little bit about this with you, Doug, because I know Eddy had mentioned that ESG is a risk management tool. I want to dig into this because I think each of those letters, environment, social, or governance, mean very different things, and they package them up into one. But there's actually, I would say, there's very big differences between all three, and the implications are quite large. So, kind of, what are your thoughts about that, Doug?
Well, I mean, I guess I struggle to identify that as a risk management tool. I mean, as you know, the basic core of investing, Kirk, is that risk. If we think of risk and portfolio risk, we do think of being more diversified, as a way of potentially eliminating risk, but being more diversified, again, getting at its core levels has a lot to do with correlation. And I guess, if you are taking a look at correlations of ESG versus other types of investments, if you can find a moat within that investing that has a history or track record of being correlated differently than the rest of the market, then congratulations, you may have found something that might be a risk management tool. And of course, if you try to get outside your investments, just think conceptually, yeah, ESG might be a risk management tool if you're thinking about life and sustainability, because yes, I mean, I think most people would agree if we don't destroy the planet through pollution and waste and nuclear, fallout and chemicals and things like that, then yes, we've reduced our risk of survival. But I'm not sure that that necessarily is translating to risk of survival of your portfolio, because again, a lot of these things, as I mentioned before, they're very popular with the money that is available and freely given to new investment. A venture capitalist, a lot of Silicon Valley loves to throw money at those things you talked about, where they've become billionaires and now they have they feel this moral need to put their money towards things that make the world, in their opinion, a better place, whether you agree with what they think is a better place or not. And what you were talking about a little bit there is what's known as Maslow's hierarchy of needs. Okay, essentially that in a basic tiering of what matters to us, it starts with physiological. We need to breathe. We need to have food. We need to have sleep. We need to basically survive physically. Above that, it becomes safety, security of body, employment, resources, morality. Then it becomes love and belonging, friendship, intimacy. Then it becomes esteem, confidence, achievement, respect of others. And finally, there becomes this level of self-actualization, morality, creativity, spontaneity, problem solving, lack of prejudice, acceptance of facts. Okay. This is going to be something that that most of those people that have their basic core physiological and financial needs taken care of are able to begin looking beyond that, to a greater meaning. We go through this process when we talk about financial planning with clients, because people will say, well, it's about making money. Well, what is important about money to you? Money does nothing. We've talked about this before. The Germans burnt marks just to stay warm in the 1920s. Money was meaningless to them because it didn't afford anything. So once you get to the point in which money is enough to be able to afford what you need at the bottom level of that hierarchy, then you could get to a point where you can say, well, I don't need to worry about money anymore. And now I can begin to have confidence and use my money for greater spiritual things. And that's really what matters when we get into financial planning, is what matters to you, because that's what it's about. Someone like Bill Gates, who's worth $78 billion, has created the Gates Foundation. Well, that right there is someone who is already at the top of that pyramid. That's self-actualization. Most of Silicon Valley's at that level as well. So those organizations, they tend to throw money at these concepts that they believe match what is important to them, because now it's not about money for survival. And the thing about, when you go back to risk, the point of that is that those types of things become really, really popular, Kirk, in a world of free-flowing capital, right? I got lots of capital, not worried about survival, not worried about the survival of my company, not worried about survival about my portfolio. Billionaires and wealthy love to use money that they're earning an income off it, but they don't typically like to lose on their principal. So in a time in which the economy is really good and ripping and roaring, there can be a tremendous opportunity and growth in this area, because people think, look where this could go. But we've talked about this paradigm shift. If all of a sudden interest rates are higher, and that means more cost to those that have the venture capital, if all of a sudden the economy starts to wind down, where this free M2 money supply that's out there starts to dwindle and dry up, and then all of a sudden, it's a lot more expensive and more risky to use money, well, then guess what may not happen? Investment in speculative assets. Speculative assets are those things that we don't know can make money, but we think will. The things that do make money are already proven, like highly capitalized businesses like oil, tobacco. I know we've got a lot of fight against tobacco here in the United States, but around the rest of the world, it's still a very big moneymaker. And then you take a look at that and say, well, okay, those types of things we know will typically make money. But what's going to happen if the economy implodes? If we go through this paradigm shift, guess what? Money's going to pull back from speculative things. And if that does, how is that a risk management tool? So it's going to do really well and correlate really well in times of good market performance. But Kirk, you know this. When you look at correlations, it's interesting how often correlations work really well in good times, but fall apart in bad times. We're seeing that right now. Treasuries are supposed to be a safe place to be. Whoops. Okay. I'm just not sure I can see a good argument to ESG. And that's even getting into the concept of what is ESG, because like target date funds, every company running them has a different philosophy of what they're going to throw into it. So better look under the hood to figure out what you're looking at with ESG, because certain funds like BlackRock, I mean, they've still got oil companies in there. They've still got other things in there that some people may not consider to be necessarily environmental, social, and governance. But then all of a sudden, the companies that are in there that are just speculative for growth no longer have a capital money supply, and they just fall off the map. They potentially go out of business. I'm looking at solar about 10 years ago, Kirk. It was a huge push in California to push solar. There was a lot of government support and stipends for, and tax credits for solar. Germany and Europe did a ton of this as well. All of a sudden, those things dried up. And once that money was gone and it was invested, all of a sudden, solar, although I think it's come back in recent years, really dried up significantly as a place to be. Money started to flow to other places. And right now, I'd say I'd be really concerned about ESG as a risk management tool in a portfolio where most people that are listening to this are looking at going, gosh, I just lost 25%. Let's throw my money in ESG and stop the bleeding. Don't think those two things go hand in hand.
Yeah, I tend to agree with that perspective. I think, it's a complex issue that I think from a straight money perspective, it's not a great risk management tool. I think the risk management comes into play where it's a lot more nuanced. If you just look at market risk, that's probably not, I would guess. I mean, it wasn't clear from what Eddy was saying, but I would guess the risk is, if you look at, let's say, I'm not going to name a company because I'm not going to, just besmirch them. But, back in the day, like decades ago, people would dump like waste into the ocean because it was cheaper to dump it than it was to dispose of it. And I think everyone knew that was wrong, but these companies got away with it because they could. And it was a financial decision. And I think we all recognize that that's a bad thing. And that's an extreme example. But, if you're like, if you got nuclear waste and you're just leaving it on the side of the road or dumping it next to a school because it's free and because you can get away with it, that's not a good decision.
I can tell you personally, there's wells tainted everywhere around where I'm at from PFAS, from the creation of Teflon, and all the byproduct of that is now tainted water everywhere. Exactly to what you're talking about. And they used to just dump it into the landfills.
Yeah, so that's a good example. I mean, there are so many examples in our country of this happening. I think, was it Flint, Michigan's another one? There's a whole bunch of them that are out there. And then you look at lithium, right? No one wants to talk about lithium for whatever reason, probably because it goes with this movement. Lithium is extremely dangerous as a pollutant, and there's a reason we don't mine it in this country, because it's too dangerous to mine. We mine it in places like China because we don't care if they mine it. We don't care if they mine it in other countries, as long as it's not here. So I think there's this element of, business, and this has always been the case, right? And you talk about capitalism. Some people say, well, capitalism is a bad system. I agree. It's a terrible system, except for all the other systems that we've ever come up with, right? So there's, and I also love the quote of like, the capitalist is going to sell the rope to the hangman who's going to hang him with it. That's true, right? If it goes unfettered and unregulated, then people are going to do whatever they can to make a buck and to compete. So, I don't think it's a binary issue of these things are good or these things are bad. I think we all have to recognize that, everybody wants a clean planet. Okay. We talked about this. Doug and I had this, debate a few weeks ago. everyone wants a clean planet. Let's agree on certain assumptions. No one wants pollution. I mean, yes, companies may do it if they can get away with it, but nobody wants to look at the ocean and be like, oh, that looks beautiful. That garbage heap floating in the ocean, that looks beautiful. Nobody wants that. Now, the question is whether people do things because they can to make money. You know, that's a totally different issue. But I think we can all agree that nobody wants a polluted planet. No one will benefit. Our heirs, our children, our grandchildren, nobody's going to benefit from that. That being said, there's this gray area that a lot of people go in, and they want to influence policy. They want to influence decisions. They feel like their view on the world is the only view, and that the world is going to implode if we don't clean it up. You know, whether that's true or not, I don't know. I'm not smart enough to do the math or the science and say the world's warming, it's cooling, any of that. I'm not a scientist, so I'm not going to claim to be. And I think we all have to kind of take that lens of, we're not scientists, we really don't know. We only know what we're being told. So the fact that I don't know, but I still want a cleaner planet. So do I want to do my part? Absolutely. Am I going to sacrifice returns for companies that are doing good versus bad? I'd say, all right, what difference am I actually making? So here's an example. Let's say there's 2 oil companies, and I think most people in the green movement hate oil companies in large part. I think they just destroyed a Van Gogh for that, right? It was who did they yell at? Those two girls that destroyed or threw tomato soup at the Van Gogh. What was
Correct.
What was their cause? Oil.
It was all about oil. Yep. Environmental impact. Yep.
So, you know, you look at oil, right? And I think people in that movement would agree that oil is bad. I think most of them would be on the same page. But then there's degrees of that, right? We all need oil, right? If you look at Germany right now, or France, or a lot of European countries that rely on carbon-based energy, and they're trying to heat their homes. So you could say, yes, wouldn't it be great if we got rid of all of the bad things that are polluting the planet, including people, because, you know, we're part of that bad things, which, you know, you look in a binary world and everybody wants to come back to this perfect utopia, which doesn't exist. But, you know, let's just say that's the case. You look at 2 companies, maybe one is doing a better job than the other, but they're still oil companies. And this is my I guess that little quip I had with Eddy is like, look, what are you going to say? Oil companies are bad? You know, you have 3 things. You have environmental, social, and governance. Well, environmental, all the oil companies are going to fail if your criteria is that oil is bad for the environment. I don't know if it is, but maybe it is. I'm not going to sit here and say yes or no, and that's not my point. My point is that that's one criteria that they're all going to fail, right? If you take the stance that oil is bad. Then you have social. You say, well, is it socially bad? I don't know. I mean, I guess it depends what the company's doing, or how do you define social, which I think is a little bit more of a fluffy concept. And I have a gripe with the social part. Environmental, I think, is more clear cut. The social, I think, is a little bit more fluffy, where somebody could puff up a company or drop them based on what the people in charge think. So I don't like that criteria. I think it's not concrete. But then governance is something that investors have long looked at as a criteria they look at for good investments. Is the company being run well? I remember that scene in Wall Street with Gordon Gekko, who's just railing against this company. He's like, you know, you have 52 vice presidents, and we don't know where all the money goes, but it's probably all the paper getting sent back and forth between them. You know, like, he just kind of rips the company apart in that they're poorly governed as leaders. And there are a lot of companies out there that are poorly governed. They're either milking, they're milking it for their own selves, you know, or maybe they're fat, dumb, and happy, right? The companies have gotten really lazy because we haven't had a recession since 2008 and 9, and you know, it's really easy just to like sit back and cash your check. So you know, I think you know, Warren Buffett had a standard that he held companies by, which I think a few years ago he probably balked on that, in my opinion. But I think, you know, at some level you have to kind of make decisions. But, you know, I think if you're looking for corporate governance that is positive, I think that's a great criteria. So I think that if you're looking at ESG as a concept, I think there's some good parts in it, and there's some parts that need improvement. As Eddy said, there's a lot of things still being worked out. I would agree. There's when you have these fluffy standards, it's basically up to the rating agency or the person in charge of the standards to determine what the rating is and whether this is good or bad. And I don't like fluffy standards when it comes to investing. When it comes to investing, numbers are the numbers. They're either good or they're bad, but numbers are truth, right? Now, obviously, we know from corporations, they're not always truth because they do a good job at managing or massaging the numbers. But let's just remove that for the sake of argument. If you look at the numbers, you can determine, all right, these numbers are what I want them to be. Is this leadership at the company doing a good job or a bad job? Okay, you can determine that, right? And obviously there's some wiggle room, but you know, if somebody gets an A and they're doing a really poor job for shareholders, then there's something wrong with the standard, right? That's clear. You could look at that. And then environmental, I think that's kind of a touchy one because it depends. Some companies, like tech companies, are going to look good. Oil companies are going to look bad. I would say that anybody who's dealing with lithium should probably be low. Even I don't want to name companies, but electric car companies probably should be low because they're using lithium in their batteries, and lithium's bad for the environment. So you could, 2 degrees of separation, you could say, well, that's bad. Will they? Probably not. They'll say, oh, they're great for the environment because it's electric, and people don't really look at the whole equation and decide whether it's good or bad. So I think there's a bit of what should we call this, virtue signaling that goes on here that I think is probably not appropriate for finance. I think it's great that they're meeting a need in the marketplace for this, and that some people want it. But I think if there's a push, like there is a push right now for what I would call, and I'm not the only one to say this, I didn't come up with this term, although I'd love to have made that claim, is greenwashing. There's a greenwashing out there where people are basically making themselves, they're virtue signaling that they're green so they can get the approval of the public. And I just think, that's fine for a lot of things in your life, but as an investor, my opinion of things that are not investing based should matter not at all. What should matter is this a good investment or not? And if you disagree with me, if you think it should be included, that's okay too. You're entitled to your opinion. I just think that if you're going to make money, you make money, and then you use that money for whatever purposes you personally feel is appropriate. And if you want to donate it to whatever cause, you should do that. That's your right. It's your money. You do whatever you want with it. But I think when it comes to investing, you have to draw that line between the two, because if not, you're going to end up, like the early 2000s, where you were socially responsible and you did poorly because you had a bunch of tech companies when, what did the NASDAQ go down? 70% in the subsequent years from the peak. So I just, I care about the listeners of the show. I want you guys to know the truth, and I want you guys to know how to think about things. That's the point of the show, is we want to teach you how to think about investing, not what to think. So with that in mind, we're going to kind of wrap it up here in the interest of time. I know Doug has to go. Doug, final thoughts from you, and where can people find more about you?
Yeah, Kirk, I think the final thoughts that I have on this is just, and I think that the issue here is that there's really no standard on how these companies are going to be judged. The metrics are constantly changing. There was a Bloomberg article that talked about there is really no standard to where firms get the data that they use in order to put together what these ESG funds are actually going to be in. They don't measure, a lot of them don't even measure the impact on Earth and society. A lot of them gauge the opposite, potential impact of the world of a company and its shareholders, which isn't exactly what people necessarily think that they're getting into, a positive solution to make a world a better place. I like what you talked about with electric cars. I mean, the reality is most ESG investing, it's not investing in something great. I read somewhere that, basically a great way of thinking of that is it's actually just investing in something less bad. So if you do go with solar, or you do go with wind, or you do go with Tesla, well, Tesla uses lithium batteries, like you said. They also use a lot of composites throughout their car. The oil industry is the chief ingredient in all of those composites. You take a look at wind energy and solar energy. A lot of those are disposable in a short window of years. And where do they go? They go up and go into landfills. They're made of plastic. So again, it's just a redirection of petroleum in order to create these. So it makes you feel good. Say, hey, look, we're not actively burning petroleum to accomplish this. But yet at the same time, where do you think the ingredients are coming from to create these things that ultimately don't last very many years and have to be recreated again, once again, with new ingredients that you don't want to be investing in. Things like gun sales. You know, people are like, well, I don't want to invest in a gun company. Does that mean you're not going to invest in certain retail stores that might carry guns? You know, you really have to think about how far you want to go on this. And of course, what that may potentially lead you to giving up. I mean, companies like Hormel Foods, okay, it's food, right? Well, how do they treat their livestock? Exxon, they produce oil. Technology companies are constantly using energy. Crypto, plenty of conversation about how big of an environmental impact it is to mine cryptocurrencies. And again, what does that translate to? So again, I mean, there are ways that you can screen these out. Morningstar has an example of how you can screen it, but how they are setting up the metrics to screen these things, I think takes a ton of scrutiny. And again, like you said, Kirk, really, what are you trying to get at with your investing? Are you trying to make money? And if you are, do what you can to create the sustainability of your finances to produce a better life. And then when you get there, use that time, use that freedom to go work for a better place, in my opinion. My name is Douglas Heagren. It is October. We're kind of winding into the latter part of FAFSA season. So for those of you out there that have a high school senior, you know what I'm talking about. You're trying to figure out what schools, you're trying to make these last minute decisions. Don't let yourself get into the college funding pressure cooker. If you have a freshman, sophomore, junior, right now is the time to start planning for college. If not even sooner, lots of money, lots of time. It was actually Princeton Review said it could take 6 to 8 weeks just to figure out school selection. We're all busier, Kirk. I saw something recently that showed that we sleep the same number of hours, we work the same number of hours, but everybody says, I don't have time left. Social media, electronics, kids' activities are taking up every last bit of time. Where are you going to find the time to put together a really smart plan for college? Get the help, reduce that time down, experts that can walk you through the path. ProCollegePlanners.com. Start there. Let's have a conversation about how we can get your child into the right school and ultimately leap them into an extraordinary future.
Great. Well, thanks again for joining us, Doug. That's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.